The United States government is borrowing $166 billion every single month this year. And nobody seems to be asking the only question that actually matters: who is buying this debt? Because for decades, that question answered itself. Japan bought it, China bought it, pension funds bought it, oil exporters recycled their dollar reserves into it. The system ran on autopilot and nobody had to think about it. But something changed in the last 12 months, and it changed quietly. Last week, a Treasury auction came in weak. Not disastrous, just weak. Bid-to-offer ratios dropped. Indirect bidders stepped back. Dealers had to pick up more than they wanted. It wasn't a failed auction, but it was the kind of auction that makes people who watch bond markets very, very nervous. Because here's the uncomfortable question that auction raised. If the U.S. is borrowing $2 trillion this year, and the buyers who used to show up are starting to walk away, who exactly is filling the gap? And the answer is not reassuring. Let's start with the number itself, because the size of this borrowing is not normal. In fiscal year 2026, the United States government is projected to run a deficit of over $2 trillion. That's not a one-time emergency measure. That's not a pandemic response. That's not a financial crisis bailout. The economy is growing, unemployment is low, and the government is still borrowing over $2 trillion in a single year. To put that in perspective, the U.S. government is now borrowing roughly $166 billion per month. That's about $500 for every single person in the country, every month. Not once, every month. And here's the part that should make you uncomfortable. The last time the United States ran deficits this large was in 2020, when the entire economy was locked down, and the government was printing money to keep the system alive. The time before that was 2008, during the worst financial crisis in a century. But in 2026, no lockdowns, no banking system collapse, no declared emergency, just a government that has structurally decoupled spending from revenue, and a bond market that is being asked to absorb the difference. And the bond market is starting to ask questions, because here's how this is supposed to work. The Treasury issues debt, buyers show up, the auction clears, and the cycle repeats. For decades, that machine ran smoothly because there was always a buyer. Japan, the largest foreign holder of U.S. Treasuries, has over $1.2 trillion parked in American debt. China, despite years of trade tensions, still holds over $630 billion. Add in pension funds, insurance companies, sovereign wealth funds, and oil-exporting nations recycling their dollars, and the demand was always there. But that buyer base is now eroding, and it's eroding on multiple fronts simultaneously. China has been reducing its Treasury holdings for years, but the pace accelerated meaningfully after the Iran conflict. Chinese holdings have fallen to roughly $633 billion, the lowest level since 2008. That's not a minor adjustment, that's a strategic repositioning. Japan, the single largest foreign holder, is now facing its own crisis. The yen has been under relentless pressure, and Japanese authorities have spent an estimated $55 billion in recent months to defend their currency. Where does that money come from? Selling dollar-denominated assets, selling treasuries. And a recent weekly data point from the New York Fed showed Japanese holdings in custody dropping by over $8 billion in a single week. That is not normal, that is not seasonal, that is a forced seller acting under duress. And then there's a category nobody was watching: Scandinavian pension funds, Danish funds, Swedish funds. These were once reliable, pricing-sensitive buyers, the kind of investors who bought treasuries as a matter of course and never made headlines. They are now liquidating their positions entirely, not reducing, liquidating. When you add it all together, China strategically reducing, Japan forced to sell, and Scandinavian funds walking away, you get a picture that is difficult to spin positively. The historical buyers of U.S. debt are not just pausing, they are leaving. And that leaves a very uncomfortable question. Who is buying the $2 trillion in new debt that the Treasury needs to issue this year? The answer, increasingly, is a group of institutions that don't want to be buying and are being forced to. When a Treasury auction is announced, there is a group of financial institutions called primary dealers. These are the big banks: Goldman Sachs, J.P. Morgan, Citigroup, and about 20 others. They are legally obligated to bid at every Treasury auction. They have to show up. They have to buy, it's not optional. And recently, they've been buying more than they want to. Primary dealer holdings of U.S. Treasuries have surged to their highest level in 19 years. These institutions are not accumulating treasuries because they see value. They are accumulating treasuries because nobody else is showing up at the auction, and they are required by regulation to absorb whatever is left. This is not a healthy market. This is a market where the buyers of last resort are becoming the buyers of first resort. And it gets worse, because while primary dealers are being forced to absorb record amounts of new debt, the Federal Reserve, historically the ultimate backstop, is doing the opposite. The Fed is still running quantitative tightening. It is still shrinking its balance sheet. It is still a net seller of treasuries, not a buyer. So you have record issuance, shrinking foreign demand, primary dealers absorbing the excess, and the Fed, the one institution that could step in and stabilize things, actively reducing its holdings. That is not a recipe for stability. That is a recipe for rising yields, falling prices, and a bond market that becomes increasingly difficult to manage. And we're already seeing the warning signs. In late April, a 2-year Treasury auction came in with a bid-to-cover ratio of just 2.44, one of the weakest demand readings in recent history. In March, a 5-year auction posted a bid-to-cover of 2.29, the lowest since September of 2022. And a recent 7-year auction saw indirect bidder participation drop to just 58%, meaning the buyers who actually want to own the debt are stepping back, and the dealers who have to buy are stepping in. These are not failed auctions, but they are auctions that are getting harder, slowly, steadily, and in a direction that should concern anyone who owns bonds, stocks, or real estate. And now we have to talk about the part that makes all of this more urgent, because it's not just the $2 trillion in new borrowing this year. It's the nearly $10 trillion in existing debt that needs to be refinanced over the next 12 months. $10 trillion, let that number sit for a second. That debt was issued when interest rates were near zero. During the pandemic, during the years of easy money, when the government could borrow almost for free. Those debts are now maturing, and they need to be rolled over, replaced with new debt at today's rates. Today's rates are not 0%. Today's rates are 4 to 5% on the long end. And the 30-year Treasury yield recently touched 5% for the first time in years. Every time a Treasury bond matures and gets refinanced at a higher rate, the government's interest bill goes up, permanently. And the scale of this is almost impossible to process. The United States government is already spending over $1 trillion per year just on interest payments, more than the entire defense budget. If average refinancing rates climb just one more percentage point, that adds hundreds of billions in additional annual interest costs. If rates reach 6%, interest payments alone could consume close to half of all federal tax revenue. That is the point where the math stops working. That is the point where the bond market starts asking whether the borrower can actually service the debt, not in theory, not in the long run, but right now. And remember, Moody's already stripped the United States of its last AAA credit rating. All 3 major agencies have now downgraded the country. The stated reasons were not about short-term default risk. They were about the trajectory, the long-term path of debt accumulation, and the political inability to change course. The bond market is not panicking, but it is paying attention. And when the biggest borrower in the history of modern finance is borrowing $2 trillion a year, and the traditional buyers are walking away, and the debt that needs to be rolled over is nearly $10 trillion at much higher rates, the bond market does not need to panic to cause serious damage. It just needs to demand a higher yield, and it is already doing that. So let me answer the question I started with. Who is buying the $2 trillion in U.S. debt this year? The honest answer is, nobody who wants to. China is not buying, it's selling. Japan is not buying voluntarily, it's selling to defend its currency. Scandinavian pension funds are liquidating. The primary dealers are buying because they have to, not because they see value. And the Federal Reserve, the one institution that could step in, is still shrinking its balance sheet. The buyers that remain are buying out of obligation, out of inertia, or out of a lack of alternatives. And that is a fragile foundation on which to build the financing of the world's largest economy. The uncomfortable truth is that the demand for U.S. debt is no longer automatic. And when demand is no longer automatic, the price has to adjust. And the price of U.S. debt is the yield, the interest rate that flows through into mortgage rates, corporate borrowing costs, stock valuations, and the value of the dollar. This is not a story about default. The United States can always print money to pay its bills, but printing money to pay bills has consequences. For inflation, for the currency, for the purchasing power of every dollar in your pocket. So the next time you hear someone say that the national debt doesn't matter, or that someone will always buy our bonds, ask yourself, if that were true, why are the people who used to buy them walking away? Because what they're seeing is a borrower that needs more money than ever. At a time when the cost of borrowing is rising, the buyer base is shrinking, and the refinancing wall is looming. That is not a crisis today, but it is a vulnerability that, in the wrong moment, becomes something much harder to manage. If this video gave you a clearer picture of what's actually happening beneath the surface of the Treasury market, subscribe to MoneyNoteLab. We cover the macro stories that mainstream financial media is too distracted to explain properly. And I want to hear from you. Do you think the bond market is overreacting, or do you think we're underestimating the risk? Drop your take in the comments. See you in the next one.